Hey Jim, I've been learning about Forex trading, and I'm curious about determining the optimal points of entry and exit in trades. How do traders identify these points effectively?
Hi Sarah. Determining the right points of entry and exit in Forex trading is crucial for maximizing profits and minimizing losses. There are several approaches that traders use to identify these points. One common method is through technical analysis, where traders analyze price charts and use various indicators and patterns to identify potential entry and exit levels.
That sounds interesting. Can you give me an example of how technical analysis can help identify entry and exit points?
Certainly, Sarah. Let's say a trader uses a trend-following strategy. They might look for a strong uptrend and wait for a pullback or a retracement in price. The trader could use indicators like moving averages or trend lines to identify potential support levels where they could enter the trade. For the exit, they may set profit targets at resistance levels or use trailing stop-loss orders to capture as much profit as possible if the trend continues.
I see. So, technical analysis can provide valuable information about support and resistance levels, trend direction, and potential price patterns that can help determine entry and exit points. Are there any other methods traders use?
Absolutely. Another approach is using fundamental analysis to identify entry and exit points. Fundamental analysis involves assessing economic data, geopolitical events, and other macroeconomic factors that can impact currency prices. For example, a trader might analyze economic indicators like interest rates, GDP growth, or employment data to determine the strength or weakness of a currency. They may enter a trade based on positive economic news or exit if negative news affects the currency's outlook.
That's interesting. So, while technical analysis focuses on price movements and indicators, fundamental analysis looks at the broader economic and geopolitical factors. Are there any other considerations for determining entry and exit points?
Yes, sentiment analysis can also play a role in identifying entry and exit points. Sentiment analysis involves assessing the overall market sentiment and trader behavior. Traders may enter a trade if there is positive sentiment towards a currency, indicating a potential buying opportunity. Conversely, negative sentiment may trigger an exit if it suggests a bearish sentiment and increased selling pressure.
I see. So, sentiment analysis can provide insights into the emotions and attitudes of traders, which can influence entry and exit decisions. It seems like a combination of technical, fundamental, and sentiment analysis can provide a more comprehensive view.
Absolutely, Sarah. Combining these different forms of analysis can help traders make more informed decisions. It's important to find a balance and use multiple tools and indicators that align with your trading strategy and personal style.
That makes sense. It seems like finding a suitable point of entry and exit requires a holistic approach, considering multiple factors and aligning them with one's trading strategy.
Exactly, Sarah. It takes practice and experience to develop a keen sense of identifying optimal entry and exit points. It's important to backtest your strategy, refine it over time, and adapt to changing market conditions.
Thank you for sharing these insights, Jim. I'll definitely explore different approaches and work on honing my skills in identifying entry and exit points. It's a critical aspect of successful trading.
You're welcome, Sarah. I'm glad I could help. Remember, continuous learning, practice, and discipline are key as you develop your skills in determining entry and exit points. If you have any more questions or need further guidance, feel free to reach out. Happy trading!
Oh yes. Jim, I've been hearing a lot about backtesting in Forex trading. Can you explain what it is and why it's important?
Hi Sarah. Backtesting is a process in which traders simulate their trading strategy using historical price data to assess its effectiveness and profitability. It involves applying the rules and conditions of the strategy to past market data to see how it would have performed in real time. Backtesting is crucial because it helps traders evaluate the viability of their strategy before risking real money in the market.
That sounds useful. So, by backtesting, traders can get a sense of how their strategy would have performed in the past. How can traders perform a backtest effectively?
To perform an effective backtest, Traders need to gather historical price data for the currency pairs they are interested in. They then apply their trading strategies, rules and conditions to that data, using a backtesting software or platform. The software will simulate trades based on the historical data, allowing traders to assess the strategy's performance in terms of profitability, drawdowns, win rates, and other key metrics.
That sounds comprehensive. Are there any challenges or limitations associated with backtesting?
Yes, there are a few challenges and limitations to consider. First, it's important to note that backtesting relies on historical data, which may not fully capture the current market conditions or unforeseen events. Also, slippage and trading costs are often not accounted for in backtesting, which can impact real-world performance. It's essential to consider these factors and make adjustments when applying the strategy in live trading.
I understand. So, backtesting provides valuable insights, but traders should also be mindful of the limitations and make adjustments when necessary. How can traders analyze and interpret the results of a backtest?
When analyzing backtest results, traders look at various performance metrics such as profit and loss, maximum drawdown, win rate, and risk-reward ratio. These metrics help evaluate the strategy's overall profitability and risk management capabilities. Traders also examine equity curves and trade logs to gain insights into the strategy's performance over time, identifying strengths and weaknesses that may need refinement.
That makes sense. So, analyzing the performance metrics and examining the equity curve can give traders a better understanding of their strategy's strengths and areas for improvement. How often should traders conduct backtests?
Traders should perform regular backtests to assess the ongoing viability of their strategy. It's recommended to backtest the strategy using different market conditions and time periods to ensure its robustness. Backtesting should also be combined with forward testing, which involves applying the strategy in a simulated or demo trading environment to validate its performance in real time.
That's helpful advice. So, combining backtesting with forward testing allows traders to validate their strategy and gain confidence in its real-time performance. Are there any resources or tools that traders can use for backtesting?
There are several resources and tools available for backtesting. Many trading platforms offer built-in backtesting features, allowing traders to apply their strategies to historical data. Additionally, there are third-party software and platforms specifically designed for backtesting, offering more advanced functionalities and analytics. Traders can also utilize programming languages like Python or R to create custom backtesting scripts.
That's good to know. It seems like there are plenty of options available to traders for conducting backtests. I'll definitely explore these resources as I work on refining my trading strategy.
That's great to hear, Sarah. Backtesting is a valuable tool for traders to fine-tune their strategies and gain confidence in their approach. Remember to consider the limitations, adapt as needed, and combine backtesting with forward testing for a comprehensive evaluation.